All right, today we're cracking open the rule book that governs the entire financial market in Papua New Guinea. It's the Securities Act of 1997. Now, this one law is basically the blueprint for how investments are offered, traded, and most importantly, protected. So let's dive right in. Here's our game plan. We're going to walk through 6 key parts. First, we'll cover the basics of the rule book itself. Then we'll meet the referee, who makes sure everyone plays fair. We'll check out the playground, the stock exchange, and then get into how companies make promises to investors. After that, we'll see what happens when people cheat, and finally, we'll tie it all together and talk about why this law is so important. So let me ask you a pretty serious question. What's stopping your investments from just, poof, disappearing overnight? The answer, in one word, is regulation. This act is meant to be that critical safety net, a set of rules built to protect you, the investor, and to keep confidence in the entire system. It's what turns a complete gamble into a calculated risk. Okay, let's start at square one. Every fair game needs a clear set of rules, right? Well, in the world of finance, those rules are all built around one single central idea. And that idea is the security. It sounds a little technical, I know, but it's really just the legal name for a financial investment. Like the shares you buy in a company or a bond. These are all securities, and they're the very things this entire law is designed to manage. And really, this gets to the heart of it. The goal here isn't to make things confusing. It's all about building trust. A market that's fair, orderly, and transparent is one where everyday people feel safe enough to invest their money. And that, in turn, is what fuels the whole economy. It's a rulebook for everyone's benefit. Of course, rules are pretty useless if there's no one around to enforce them. So that brings us to the market's official referee. This is the Securities Commission of Papua New Guinea. They were actually created by the act itself to be the central watchdog. It's their job to keep an eye on the market, look into anything that seems fishy, and make sure everybody is playing by the rules we're talking about. Now, what's fascinating is just how much power this commission has. I mean, look at this. They can force people to show up and testify under oath. They can demand to see a company's books. They can halt trading on a stock if they think the public is at risk. This is a huge deal because financial wrongdoing loves to hide in the fine print. These powers, which come straight from Section 8 of the Act, give the referee real teeth. And this is just so important. This quote from the Act basically gives the Commission legal armor. It means they can make tough calls to protect the market without being terrified of getting hit with nuisance lawsuits. As long as they are acting in good faith, they are protected, which frees them up to do their job properly. Okay, so we've got the rules and we've got the referee. Now let's talk about the game itself, the stock exchange, and the safety features that are built right into it for the investors. You see, the Act is really clear that a stock exchange can't just be some random free-for-all marketplace. It has to be an approved stock exchange. That means it's licensed, it's regulated, and it has super strict rules about how business is done, all designed to protect the public. But let's be real. What happens when someone does break the rules and another person loses money? Well, the Act planned for that. It created an absolutely crucial safety net, which you can think of as a mandatory insurance policy for the entire market. It's called the Fidelity Fund. So according to Section 34, every single approved stock exchange is required to set up one of these Fidelity funds, and they have to put in a minimum of 500,000 kina. That is a serious pool of money just sitting there ready to compensate investors if a firm, say, illegally uses their funds. And here's what that means for an individual investor. Section 39 says that if you lose money because of a single bad actor, the fund can pay out up to 250,000 kina to cover your losses. This turns the idea of safety from a concept into cold, hard cash. Now, how does a company even get to ask the public for money in the first place? Well, they can't just put out a hat. They have to make a very specific, legally binding promise. And that promise is called the prospectus. Honestly, the best way to think about it is like the nutrition label on your food. It's legally required to tell you everything that's inside, the good, the bad, and the ugly before you decide to buy. It's the official product label for an investment. And getting that label approved is no walk in the park. It's a whole journey. And pay attention to step 2. Every single director has to sign it. That's huge. It creates personal accountability. Nobody can turn around later and say, "Oh, I didn't know that was in there." The entire process is designed to force full and honest disclosure. So it's the difference between, say, a flashy ad you might see and the actual prospectus.
Well, this chart nails it. An ad can give you the highlights, the teaser trailer, right? But it legally has to point you toward the full movie, the prospectus. A company is not allowed to take your money based on the ad alone. The investment decision has to be based on the full, detailed, and officially registered document.
Now, even with all these rules, you know there are always going to be people who try to cheat the system. So the Act dedicates a whole section to defining and punishing that kind of foul play.
First up is market manipulation. This is basically about creating a fake reality. For instance, a group of traders could buy and sell a stock back and forth to each other just to make it look like there's a ton of interest. Other people see the activity, they jump in, the price skyrockets, and the original group sells for a huge profit. Section 95 says that is totally illegal.
And then, of course, there's the classic: insider trading. The key idea here is inside information. It's valuable, secret information that the public doesn't have. So if you're an executive and you know your company's about to announce something huge that will send the stock price soaring, and you buy a bunch of shares right before the announcement, well, you're basically playing with cheat codes. This law is all about making sure everyone plays on a level field.
And the Act does not mess around with the consequences. For big offenses, we're talking about heavy fines and even prison time. The message is crystal clear. If you try to cheat the system, you're going to face some serious heat. So we've gone through the rules, the referee, the penalties. Let's just pull back for a second and ask the biggest question of all. Why does any of this really matter? It matters because this act is so much more than a legal document. It's the very foundation of trust in the market. Think about it. Without these rules for fairness and transparency, would you really risk your savings? Probably not. This framework gives investors the confidence they need to participate. And when people invest, businesses can raise money to grow, to innovate, and to create jobs. It's a vital pillar for the entire economy. And that leaves us with one final big idea to chew on. We've seen how these regulations build a safe, trustworthy market. But there's always this tension, right? Too little regulation and you get chaos. But too much regulation can sometimes stifle new ideas and growth. So the constant challenge for any country is trying to find that perfect balance. Where's the sweet spot between safety and innovation? It's definitely something to think about.